Hey everybody, welcome back to the 4-Star Today's Market Explained. This is our Halloween. It's a spooky episode, Chris. I'm Brian Kasal. I'm your host, along with my co-host Christopher Reardon. Chris, welcome to the podcast.
Thanks, Brian. And I guess you could say in Chicago, there's nothing more spookier than the weather since it's snowing on Halloween this year. So got
Knowing
that going.
outside, we're in our new headquarters. This is the first podcast from our new headquarters. So we're at 1 North LaSalle in our new 22nd floor headquarters, and it's snowing outside our window. So there we are. So everybody, welcome to the new headquarters and the new podcast for today as we end the month of October. And we're coming up on daylight savings time, going away. We're back to the regular time this weekend. So it's all that great stuff that happens in fall. So Chris is with me today. So Chris, for those of you who don't know, Chris is the Director of Development for 4-Star. He's the master of all the portfolio activity, trading reports. Chris still loves his Cleveland Indians. I don't know why. But caretaker of his golden doodle puppy, and he has 3 young Reardons with him in the household. Amazing. So Chris, amazing guy. Welcome to our podcast.
Thanks, Brian. Glad to be here and glad to talk a little bit about the markets.
And I'm the founder and CEO of 4-Star. I'm an Eagle Scout. I'm a trustee of the National Boy Scout Foundation. I'm an advisor to CEOs and insiders of companies. I'm the chief dad to Quinn and Evan, and husband to the amazing Tripty. So that's our intro today. If you like what you're hearing, please tell your friends and give us a 5 out of 5. The more rankings we get, the better it is, and then more people hear this, and the better it is for everybody. So thanks for being with us today on Halloween. Chris, we're going to do our markets. We're going to do economy. We're going to talk about what we see out there in general in the economic world. No interview today, just markets. So a lot of strange things are going on again, Chris. It looks like we have commodities in the lead again. So give us the skinny. What's happening?
Yeah, so a little bit of a shakeup and some changes from the asset allocation front. As you alluded to, Brian, commodities moved up 2 positions to retake that number 1 spot. It gained 9 points from the last podcast and is now at 255 tally points. International equities held in the number 2 position, and it lost 9 points since the last podcast. So it's at 241 tally points. Mm-hmm. And then domestic equities was the big loser, if you will, from an asset allocation perspective. It moved down 2 positions and lost 19 points from the last podcast. So it's at 237 points now. So really, commodities definitely did move up, but I'd say the story was more or less the top 2 asset classes, international equities and domestic equities, falling backwards. So that's where we really saw those weakness in those 2 asset classes. Cash is in 4th, and it gained 16 points from the last podcast. So we're starting to see some life out of cash. Usually if we see cash continue to move up and overtake into the 3rd and potentially 2nd and 1st position, that would be a heavy indicator of really volatile markets. Obviously, the markets have been volatile the last couple weeks, 2-3 weeks. But if this continues, we would really expect to see that cash potentially move upwards and gain more traction. Currencies is in 5th, plus 4 from the last podcast, and it's at 104 now. And then fixed income is still in dead last, minus 2 points from the last podcast, and at 79 tally points. So not a whole lot of change in the bottom 2. It is interesting to note, for the first time in a while, we are starting to see a little bit of life in cash, starting to move up and gain some points here. So that'll be a very interesting thing to watch moving forward, and it'll be interesting to see if this volatility continues to move that tally score up.
Yes. So Chris, a lot of interesting thoughts on this whole alignment. So commodities being number 1, and they're number 1 by a pretty good margin. So clearly commodities are in the lead. We talked about this in the past. Commodities are not really a great asset class to be in the lead because they're a cost structure to business, to people. So commodities being in the lead for a long time hurts the economy. But in the short run, there's oil moving, there's precious metals, different commodities, and we can certainly, take advantage of that. And we have a couple of portfolios that do that, take advantage of that. But so we're in the lead again. That's the way it was last year in 2022, which was a very bad year for the market, and economy was weak but not horrible. People think we're going into an economic downturn here. We're going to talk about that later, but that's a signal that we're going into an economic downturn. And then domestic equities took a real big move down, and so that is a reflection of the technology. Huge boom, and now technology is in a correction, down more than 10% from the high, and a little rally today and yesterday, but it looks like the commodity or the technologies may keep going down. We'll see. Maybe this is the positive refreshers, or maybe this is the beginning of a big decline. But U.S. stocks did worse than international too, Chris. So international has been in one of the best runs for a while, and then it looked like it was fading, but it's come right back. So international stronger, and we have not seen a real strong international stock move since the mid 2000s. We had a little rally, I think it was in 2015, where international outperformed everything for like 4 or 5 months. But this move this year, since the first quarter, has put international on a real strong footing in dollar terms, because we're dollar investors in the U.S., right? So that's interesting. And then, Chris, the other really notable thing, well, two more things. Cash has made that big move. Now, cash would make that move if they were worried about the markets in general, whatever the yields are. But now institutional money funds are paying over 5%. So if you can get 5% on a money fund, people are selling bonds, they're selling other assets, and just saying, I'm just going to go riskless at 5%. We haven't seen that in 15 years or more. So that could be part of the reason cash is so strong, Chris, don't you think?
Yeah, no, for sure. I mean, I think we've the first time in a while we've seen I don't say risk-free, but relatively risk-free investments yielding 5-6%, which is a pretty good yield. And obviously, going back 2 or 3 years, if you could tell someone they could be in a money market fund yielding that, they would take that all day, all day, every day. So it's big, and we have seen that's kind of the hottest investment, if you will. It's been the hottest investment of 2023, I would say. It's been a big kind of keyword, really. The other thing I'll note real quick is with the commodities, it's interesting with this commodity cycle because, usually when you see commodities moving, it's kind of entering a boom cycle. You have steel, you have construction, you have, usually there's demand, right, for commodities. So you think building, you think, growing. But this commodities cycle, if you will, that's causing it to move up is different, right? We're seeing commodities making a move up because of supply constraints. So, you have the Israel-Hamas war going on, and that's constraining oil, causing the price to go up, or potentially constraining oil. You have the Ukrainian-Russian conflict, and that's constraining the price of wheat because they can't export it. So we're seeing wheat. So we're having these different inputs and outputs that are being constrained and causing the price of them to move upwards. And it's kind of causing a little bit of volatility and havoc within the commodities market. So it's a very interesting market than we've seen in the past. And it'll be interesting to see how that plays. Like you said, Brian, international has done very well so far. We'll see if that continues. There are some headwinds, as I alluded to. There's a couple major conflicts now going on in the European continent. And then you have the potential of outbreaks in the Pacific. So there's some headwinds, but I think a lot of people were surprised with how well the international markets have done this year. So maybe they do continue to surprise.
Yeah, they do. And currencies, which all the currencies are to us, are cash in someone else's country, essentially. That's what a currency is, and that's moving up too, as much, not as much as our domestic cash, but that's moving up. And then the other real headline story in this six asset class lineup, Chris, is fixed income. So fixed income is now at 79, and it's one of the lowest readings I've ever seen in this lineup. Only 79 tally scores. And with fixed income going down and interest rates being higher for longer on the Fed funds rate, and then they're even talking about raising into next year, later next year. So we may not see interest rates start to ease again until 2025. That's some of the talk that's going on now. So the bear market for fixed income continues. So, Chris, a lot of folks are selling their bonds and just leaving in cash.
Yeah, no, I mean, it makes perfect sense. I mean, you don't have to worry about the duration risk, right? That you have to hold that bond for 10 years and maybe interest rates, like you said, Brian, go higher and you're losing out on, potential more interest you could get. So being in cash gives you the flexibility to kind of deploy. And then also, I think a lot of people are looking, like you said, Brian, that at some point, it might be a year, it might be 2 years, we don't know. The Fed is eventually going to relinquish and start to lower rates. I think a lot of people are anticipating that as a kind of a bottom and have to see the markets rebound. So, I think that's one of the prime reasons that money markets, including the yield, but another prime reason that they've been so popular this year.
Yeah. So if fixed income, last year fixed income, the index was down 12%, which is all total return. There was virtually no income, maybe 1% out of bonds at the beginning of the year, and then it spiked upward so quickly. So, people don't want to lose another 12% of their bonds, so they're selling bonds and holding money markets with whatever cash they can get out of their bonds and be able to buy bonds later on. Anyone who was around in the 1980s when interest rates were spiking upward, September 1981 was the high for the federal funds rate of 16.4%. But from that point, then rates were starting to go down. And I got in the industry in 1983. We had just seen the bull market kicked off in August of 1982, and they were talking about what they call disinflation. So instead of high inflation, they're talking about inflation going backward, meaning less severe. That's what we saw last year. But now inflation seems to be going up again in America, and interest rates are staying steady and might rise even higher. So why would people want to hold fixed income in that environment? Just like in the 70s and the early 80s, people were getting out of bonds as well. So that's where we are. So fixed income continues to be very, very difficult. Chris, the markets broke to new lows on October 3rd, and then we just broke those October 3rd lows again here recently. Last week was a very difficult week in the market. And then now, of course, yesterday we had a little rally after a difficult week. Today is Tuesday, the 31st, and market's up a little bit, but it looks like it might be rolling over and maybe we'll go back down even more. And, the interesting thing, Chris, from the market perspective is the S&P 500 is still up about 7%. But if you take out the top 7 stocks, the S&P 493, so 500 minus 7, is flat on the year. And there are 8 out of 11 groups in the S&P are down on the year. So that just shows what the markets have done. The Dow Jones index is down on the year. So with only 7 stocks out of the index outperforming, unless you put all your money in those 7 stocks, you're probably down or flat for the year, or even seriously down, as a lot of investors are. So it's really kind of a messy, messy time. So after a messy, bad year last year, now we're having another sloppy year this year. So let's hope things get better, right? That's all we can ask for. And they will, but in the short run, it's been very difficult. So, Chris, and then on Tuesday, we saw the bond yield hit over 5% last Tuesday. And now big reversal back down to 4.8. So we still have that inverted yield curve. And you've talked about that a lot, Chris, that we have an inverted yield curve.
Yeah, I mean, I think whenever we have an inverted yield curve, it's going to cause issue and havoc in the bond markets and even in the stock market, right? When you can get more yield in the short term, you can get a long term, then what's the incentive there? You think about, and I know some of the language with bonds for just some of our general listeners can sound a bit complicated, but you just think about it. The more you're holding an investment, so if you're going to buy a bond that's going to pay you for 10 years, you're locking in an interest rate. Usually you end up, getting a little bit higher of an interest rate. As bonds come due and new companies have to roll out new bonds, what you get is this inverted yield. So that short-term bonds are actually paying higher interest than these long-term. And it causes a lot of issues and problems within the bond market, as you could imagine. And so you get kind of the prices get depressed on the long-term bonds and to bring the yields up, and it causes a lot of volatility. So we're certainly seeing that play out here, and it's most likely going to continue to play out. I mean, anytime you are pushing interest rates up, which is essentially what the Fed is doing, there is always going to be the anticipation or expectation of, an inverted yield curve like we're seeing now. So it's not unexpected, but it certainly does cause issues within the general markets.
Definitely. And we'll talk a little bit more about that in a minute and about the economy. And Chris, you mentioned volatility. Also causing volatility is we have a new war, the Israeli war. Started on October 7th, and Hamas went into Israel, of course. Everyone's been hearing about this. So now, all the different groups in the world are lining up either with the Hamas group, who, slaughtered and murdered people. And it was a crazy, crazy thing. And then, of course, the Ukraine war is still going on with Russia. And now there's talk there might be a war in Taiwan where the Chinese want to get Taiwan back. And because America has been actually acting very weak in the current administration, there's still a belief that that might happen. So that we don't talk much about geopolitical politics, but now the volatility also may be partially being caused by uncertainty about the war. Certainly been an uncertain month, with October being a very, very strange month. Usually September is the worst month of the stock market, but this year October was for sure. So we'll see if the volatility continues. Treasuries yields hit a 16-year high. Now, Chris, you've got a little more detail on the economy. The economy continues to expand at higher rates than people figured, and inflation's going back up. Wasn't the Fed trying to raise rates to slow the economy down, Chris?
Well, yeah, I mean, it's the economy has proven to be more resilient, I think, than even the Federal Reserve expected. And the latest GDP number that came out, I think, like you said, Brian, was way above expectations. So the U.S. GDP expanded at 4.9% at an annual rate in the third quarter, and that's seasonally adjusted and inflation adjusted, I should mention. And that's more than double the pace at the second quarter. So, I think there are definitely a lot of reasons for this. That seems large. I think you still have the U.S. consumer willing to spend. Inflation's there, but I think the job market has held up relatively well. We are seeing wage gains. That there's certain areas that are holding. I think there still is. I mean, it's been a couple of years now since we've had this kind of COVID pandemic, but there's still a large pent-up demand for traveling, for the services, going to restaurants, and kind of things people had on their bucket list or checklist that they had to push off for 2 years. So I still think we're seeing kind of the tail end of that backlog that was kind of unraveling out. The other big key is you have a lot of the baby boomer generation who are entering that retirement phase, and they've done pretty well, and now they have bond yields that are yields on money markets that are yielding them 5-6%. They're feeling more comfortable in their spending. So it's certainly that baby boomer generation that is helping prop up that spending that has driven this GDP. These GDP numbers we've seen.
Yes.
On top of that, the employers, this just came out that employers spent 1.1% more on wages and benefits in the third quarter than the prior quarter. So we're starting to see that wage gains reaccelerate. This is good on one hand, but it's also an issue because, and this has been front news with the, you've seen a lot of, we talked about this with the strikes, the union strikes, United Auto Workers. If any of you, our listeners, have listened to some of the news about it, what the United Auto Workers Union is asking for is quite considerable. I mean, 20% raises off the bat, with kickers in the back end that raise another 5% for the first 5 years. I mean, really large numbers. So you think about it, what that impact that's going to have on the markets is it's going to reignite inflation. You're adding a lot more money back into the market. And if we see that get spread out amongst other groups, it'll be interesting to see. So it's great for the employees, I guess. It's great for these workers, but in the long run, what it's really going to do is just heat inflation back up. And we're almost going to have a potential feedback loop, and that's what the Fed does not want. So if you have employees making more money, significantly more money, they're going to spend more. They're going to spend more. Prices are going to go up because demand's going to go up, and then you're going to have employees demanding more money because prices are going up, and you just have this feedback loop. And that's what we're trying to avoid. And we really haven't seen the recession. That's why a lot of economists said, to really have the impact the Fed needs, we need to have a recession, right? We need to restrict. We need to not have employees getting raises. We need to have, as sad as it is, you need to have firings. You need to have people, being let go, things like that, because that restricts the amount being spent, lowers demand, and that's going to lower inflation overall. As simple as that. So we really haven't seen that. It'll be interesting to see how that plays out. But it's pretty fascinating, I would say, right now, where I don't think the Fed really thought that this would be holding on this labor market as much as it has. And then, okay.
I was going to say, Chris, so about 3 weeks ago, the CNBC reporter Rick Santelli, who is famous for these rants, he did a rant back in 2010 that led to the movement, the Tea Party movement nationally. He did a rant about interest rates. So if the spike in interest rates we have had doesn't close off the economy and slow it down a little bit, and you reduce inflation goes back up, Fed may have to keep raising. And he said, by his chart, the Fed could go to 13% on Fed funds rate, and all the other rates would presumably be lower in an inverted yield curve. But at 13%, that would be horrific, and that would be a long way from here at 5%. So that could be very, very damaging. But by the trajectory, the way things have moved, that looks like it, it's a possibility. I think it's a limited possibility, but anything's possible, Chris. And so then that would really create a lot of changes in the economy. But if we don't solve this inflation and we don't slow the economy down, that's causing the inflation and wage inflation, everything else, we could see rates go higher.
Yeah, I mean, certainly. Yeah, I think that obviously that what I would consider to be a worst case scenario, a tail end risk, if you will.
Oh, for sure.
But I think right now the expectation is we're going to start, and we don't know. I mean, this could prove to be incorrect, but we're going to start to see some of this consumer spending dissipate over the next quarter or two. I will say we talked about this on here. We did have student loan repayments resume, which is going to be a big chunk, and I think that's going to have a significant material impact on spending. Now that you have people who have now $900, in some cases $1,000+ of payments they have to make a month, so that's going to pull a lot of money out of the market. So we'll see. I think the expectation is that we're going to start to see a slowdown as we enter Q4, or we're in Q4 now, as we kind of enter the mid and end of Q4 and then into Q1, and we really have to, I think the Fed has to kind of take note of that and kind of see where, what the impact is there. That's why I think right now we're really in a wait and see, I think, measurement for the Fed, and the next quarter could dictate a lot.
Yeah. So your home sales numbers and a few other things, right?
Yep. So then the next thing I'll touch on is existing home sales. They decreased 2% in September from the prior month, to a seasonally adjusted annual rate of 3.96 million. So this is, interestingly enough, the lowest rate since October of 2010. And on an annual basis, or year over year, the sales fell 15.4% from a year earlier. So we continue to see, we've talked about this, I think, at length on this podcast, but continue to see a slowdown in the existing home sales market, and it's causing a lot of crazy things to happen there. With these higher interest rates, you would expect, or the Fed would expect, home prices to go down because buyers have to now bear a higher cost to purchase a home. Well, it did for about a month or two, but now we're starting to see home prices creep back up again because that supply and demand is playing havoc. And since there's very, very limited supply and that demand's even staying somewhat the same, we're seeing the home prices creep back upwards. So really interesting market right now in the real estate sector. And then pivoting to the international front, we continue to see bad news out of China. So China's Purchasing Managers Index for the manufacturing sector fell to 49.5 in October from 50.2 in September. So if you guys will recall, anything below 50 is a contraction. So we're seeing China's manufacturing sector really start to move into contraction. A lot of that was due to weakening orders, both domestic, so in China and overseas. So we're seeing kind of a slowdown, and then that's a big deal for global growth as well. And that would point to a worsening market coming down the line, because China is a big consumer, and so if we're seeing China consume less, it's definitely going to have a material impact on a global world as far as consumption wise. And then the last thing I'll put in there, the Eurozone GDP came in at an annualized 0.4% in the third quarter, which is a very stark contrast to the US GDP, which was 4.9%. So really seeing a deviation with the EU continuing to slow down, and the US continuing to accelerate, at least with the numbers we have so far. I will say the inflation has come down significantly in the European markets. A lot of that was due to gasoline shortages, things like that, prices. So we have seen that get reined in a little bit more. They had more extreme numbers in the top side. It's come back a little quicker. But it seems like the Eurozone economy is certainly slowing quicker than the US economy so far.
Yes, it seems that way. So, and then you had some other comments about different companies too, if I remember right.
Yep. So kind of what I see out there, I guess, is so the X, which is the formerly Twitter, I guess, would be, you always see it put that way. They just came out with their valuation of $19 billion, which is a very, very long way from Musk's buy of the company, purchase of the company of $44 billion. And I believe Musk finally fell below $200 billion in his net worth now with this recent kind of downgrade, if you will, or recent revaluation. So we continue to see that. Musk came out afterwards and he said that if his projections stand, and if he he's anticipating to kind of mold the company into the future, he expects it to be worth upwards of $250 billion. We'll see. That would be a tall order, but obviously Elon Musk is a very amazing guy. He's done crazy things before, so if anyone could do it, I'm sure he can. But he certainly dug himself a bit of a hole in the short term, at least, so he's got a little ways to go. And then the last thing I'll touch on or give an update on the Kaiser Permanente strike, which was the largest strike for the in the healthcare sector, largest strike on record. The healthcare workers actually went back to work without getting a new contract. So we saw the employer hold out and the workers go back to work and stop striking without a new contract. So they are still in negotiations, but they, for right now, have gone back to work. Ford, this is another one. Ford, with the United Auto Workers, has reached a tentative agreement or labor deal. And so that could bring the 6-week strike for the UAW and Ford to an end. We still have General Motors and Chrysler Stellantis are still in negotiations. Their parent company, Stellantis, I should say. So we continue to see that. But it'll be interesting. Nothing's been finalized yet that I've seen, but it's promising, I guess, that we could at least have one of the major car makers go back to work. And then this being Halloween, I'd mentioned that candy is getting more and more expensive. Prices for candy and gum jumped 7.5% in September 2023 from 2022. So we continue to see candy be one of those major holidays now where people are having to shell out $50 to $100 to get candy just to, celebrate and be able to hand it out to all the kids. So one more thing of inflation that we're seeing have a major impact.
Yes. Well, it is interesting to see what the implications of our life and our culture in America when we go through all these periods of time. But, candy is one of the losers in the whole thing, I guess. And so that's affecting us all today because this is the day for candy, Halloween, handing out candy. And so we'll see what that does to today. And it's interesting. Chris, back to the unions. You mentioned how the GM is still striking, and then they announced very good earnings, but then the unions announced a strike at their Arlington plant with General Motors. That's where they make their most profitable vehicles: Escalade, Suburban, Denali. So they've decided not to give earnings guidance because of that. And the other interesting trend is because of all the changes in the economy, we're seeing a curtailing of the electric vehicle production due to lower demand. So the dream scenario for some of the administration is that everybody drives an electric vehicle and they're getting rid of fossil fuels. That's certainly the environmentalist view of the world. Well, it turns out that people aren't that into electric vehicles. And so they're still buying vehicles, but they're buying a higher percentage now of old fossil fuel style vehicles. So they're betting on lithium ion batteries. They've invested $2 billion in factories to do that. Even though the Biden administration is heavily subsidizing, they had expected significantly more than that too. So it's interesting how things go. Even though the government wants to push a certain thing, sometimes the people say no. And right now they're kind of trending the other way on electric vehicles. Um, Other things that are upsetting the markets, the grain markets, were really, really wild last year because of all the activity going on in Ukraine, which is 20% of the world's breadbasket. It's the most fertile fields in the world is in Ukraine. And now the St. Lawrence Seaway, there's a block going on and a lot of the boats. And so that may roil the grain markets again in the short run. We're also seeing Bitcoin is up sharply. There's rumors of regulatory approval because Bitcoin isn't really accepted everywhere, and it's not accepted as a real currency in a lot of places. But if they get regulatory approval more and more in various states, we could see Bitcoin continue to run. And then in October, after we hit the lows, before we hit the recent lows, we were seeing what they call a January effect, where stocks started to pop because they were all getting hit so badly. And then they started to pop, and maybe we'll see a little bit more of the January effect in October. So, again, interesting circumstances. As we mentioned, there's an awful lot of tension in the world with all the different wars that are going on. And so we'll see how that affects everybody. We did finally get a House Speaker because the Republican House certain members ousted the current speaker, and now we finally got another speaker after about 12 days, I think. But we did put a blog post out on that, and that's kind of destabilization that we don't need as an economy. But it did roil the markets a little bit, but now it's coming back. And so we settled on Mike Johnson down in Louisiana. And of course, the different people don't like him, but we'll see where they go. I did meet some of the other leaders before who didn't make it to the top, Tom Emmer and Steve Scalise. They're actually great guys, but they didn't attract enough of the caucus to get the speakership. So, but now we have a stable government, hopefully again, although our U.S. budget deficits are very, very high. They topped $2 trillion for the last fiscal year. And of course, it's a wartime, so we're spending more money on war, but it still seems like we're spending way more than we should. The Fed admitted now that last week there were $83 billion of assets that left the banks alone. And one thing we talked about with interest rates rising, the banks have a harder time making money because they have to pay more on deposits to bring money in. And they're not making as much on bonds or other things they might do. And the housing market is slowing down a little bit. So if the banks don't get their profit equation back and under control, like earlier this year, we could see some banks fail. Anybody who was around in the 1980s was around when the Resolution Trust Corp was formed by the Reagan administration to accept receivership of all the savings and loans that went under, to the point that the majority of the savings loan industry went under. They decided to actually end FSLIC, Federal Savings and Loan Insurance Corporation, and melt everything into FDIC, Federal Deposit Insurance Corp, which insures the banks. So they turned savings loan into banks. They got rid of many of the savings loans because they were insolvent. So we could see more banks be insolvent here. We'll see how bad it gets if interest rates keep going higher. So it's in a very, very strange time. Hopefully things bottom out and we see the economy start to actually recover without all the inflation. If we have a normal low inflation economy, then that's good. But we got to whip inflation before we can do that. So that's really the big hurdle. So anyway, that's where we are here today, folks. The economy is still, positive, but with high and increasing inflation. So we need to see inflation go back down because inflation caused growth really isn't good growth because it erodes the spending power of individuals. So we need to see inflation go down. And so the markets have been choppy as a result of that. Commodities are back in the lead. So it's a very strange time. Let's hope things get better. So we pray for the world till we get over these wars. We pray for America, and the economy will recover in a proper way over the next couple of years. So in the meantime, the 4-star protection plan is in place, and we've raised a lot of cash, Chris, and we're being very protective. We're not maximum levels yet, but we could get there very soon, and then we'll just hunker down and hope we don't have a big downturn in the market. But right now, we're kind of on the losing end of that equation. So let's hope things turn around. And like I said, let's pray for everything to turn around. I think that's all we got today, Chris.
Yep, that sounds good. Thanks, Bob.
Okay. Well, great, everybody. We'll leave it there. Thanks, everybody, for being with us on this Halloween, spooky, snowy in Chicago version of the 4-star Today's Market Explained. We'll be back in November with another episode. We have some other great interviews coming out, a few blog posts. If you go on to the 4starwealth.com and look at the leadership matrix and all the other blogs that are there, there's a lot of interesting things that are being posted. We put a piece out about the House Speaker, but that's already resolved at this point. So thanks, everybody. We'll be back very soon with another episode. We'll leave it there. Have a great day.